So what if I told you that Japan, a country with just 2% of the world's population, could disrupt the entire world? Japan's government has released growth data for the first quarter of this year, and the numbers show the economy has taken a step back. Japan's three biggest names in the auto industry announced disappointing numbers for the last quarter of the business year, and they're warning of rough waters ahead. Rice prices in Japan remain stubbornly high. Consumers are struggling to put food on tables, and retailers to put products on shelves at affordable prices. The government has been trying to fix the problem with limited success. Now, you probably don't spend a lot of time thinking about Japan's economy, and most people don't. It's on the other side of the world, and not in the headlines like the US or China. But the reality is that Japan could increase interest rates in your country, crash stock portfolios all over the world, and potentially even trigger the next global recession. Because Japan is not just another country, it is one of the biggest creditors on Earth. It holds over $1 trillion in US government debt. And for decades, it's been the engine that powered some of the world's riskiest financial bets through something called the yen carry trade. And the yen is one of the most important currencies in the world, and it's also getting stronger. That sounds like a good thing, but it's actually not. We found out why in 2024. That's when the carry trade unwound, leading to a quick spike in the yen, a flash crash in Japanese stocks, and a ripple effect that hit everything from US stocks to Bitcoin. At the time, JP Morgan warned that the carry trade unwind was only halfway done. And now in 2025, that unwinding is continuing. Japanese government bonds are collapsing in value, long-term interest rates are going up, and bond auctions are failing. Because of that, we're seeing a slow-motion unwinding of trillions of dollars in global leverage. Investors are starting to feel scared, but this isn't just a story about Japan, it's the story about the end of an era, the era of easy money. As Lynn Alden puts it, when global debt is this high and demographics this broken, there's really only one way out: currency devaluation, and the realization that nothing stops this train. Once that happens, money looks for other places to go, like scarce, decentralized hard assets that can't be inflated away. So in today's video, I want to explain exactly what's going on behind the scenes, why it all matters, how it's all connected, and how I'm personally investing. With that said, let's get into it. Hi, my name is Andre Jik. Hope you're doing well. Come for the finance and stay for Japan. Let's talk about something that rarely gets talked about: demographics. Demographics explain the age structure of a country: who's working, who's spending, and who's retiring. There has to be a balance. Fewer young people, smaller workforce, slower growth, lower tax revenue. At the same time, healthcare and retirement costs go up. If a country has bad demographics, it will probably have a weak economy. Japan is the oldest country in the world. About 30% of the population is over 65. Its birth rate has been below replacement for decades, and the population has been shrinking since 2008. By 2050, Japan is projected to lose 20 million people, the equivalent of everyone in Florida. This aging crisis affects the entire economy. Fewer workers, less growth, more retirees, more government spending. The only way to keep that system running is to borrow money. That's why Japan now has the highest debt-to-GDP ratio in the developed world, over 260%, and it keeps rising. Japan got away with it because interest rates were basically zero, and the Bank of Japan was willing to buy up half the bond market. But Japanese investors still wanted returns, so they invested overseas. That's why Japan became the biggest foreign holder of US Treasuries. As of 2025, that balance is breaking. The Bank of Japan is walking away, and all that debt is starting to matter. Why should the rest of the world care? Because for decades, Japan has been the world's biggest creditor nation, with over $3 trillion in net foreign assets. They held over $1 trillion in U.S. Treasuries in 2025, along with U.S. stocks, corporate debt, and real estate. Japan's money helped finance global deficits, boost asset prices, and keep interest rates low. Why could Japan do that? Because of interest rates stuck at zero. This created one of the most important financial cheat codes of the past 30 years, the yen carry trade. Here's how it works. Borrow money in Japanese yen at super low interest, convert yen into dollars, euros, etc., invest into higher yielding assets abroad. The spread becomes free profit. In 2023, US rates were over 5% and Japan's rates were negative, huge incentive to do this trade. At its peak, Bloomberg estimated yen carry trades reached hundreds of billions globally. But this only works if Japanese rates stay low and the yen stays weak. If rates go up or the yen strengthens, the trade breaks. Borrowing gets expensive, currency losses mount, and investors have to sell US assets to cover. That's what happened in 2024. The Bank of Japan raised rates for the first time in decades. The yen surged over 10% in weeks. Japanese stocks crashed. US stocks dipped, Bitcoin dropped, and JP Morgan said the unwind had only just started. Now in 2025, Japan is still tightening. Bond yields are rising. The yen is gaining. Trillions of global leverage are at risk, one margin call at a time. And for the first time in decades, Japan may not only stop buying US Treasuries, they may start selling. What's happening in Japan's bond market is alarming. In May 2025, 30-year bond yields hit 3%, 40-year bond yields hit 3.6%, all-time high. That's historic for Japan. These are supposed to be safe, stable bonds. Now investors want a huge premium to hold them. Why? Because trust is fading. Japan's debt to GDP is 250%. It was only manageable because the Bank of Japan was printing money to buy bonds. That worked until it didn't. Now that the bank is stepping away, the market is testing what those bonds are really worth. And we just saw failed bond auctions. To get buyers back, Japan has to raise interest rates, which breaks the carry trade, and the effects are spilling over. Take Metaplanet, a Japanese company that owns thousands of Bitcoin. Its stock exploded recently. Why? Because investors are treating it as a hedge against Japan's collapsing bond market. As rates rise and the yen strengthens, shorts on Metaplanet and Bitcoin-related trades see huge losses, triggering a short squeeze. When people lose faith in the government managing debt, and when supposedly safe long-term bonds act like tech stocks, people question the entire system. In Japan, some of that money is moving into Bitcoin, either directly or through companies like Metaplanet or MicroStrategy-style strategies. This isn't about Bitcoin replacing the yen, it's about moving away from assets controlled by central banks toward assets that are finite, decentralized, and immune to manipulation. It shows how fast emotions can shift when a country's safest assets wobble. If Japan's bonds aren't safe and the central bank is out of ammo, what's next?